Finally, after some time, I was doing an exam and a lot, as you know, but we are back and we are finally at the most important chapters in the lesson. As I wrote in the message, I have decided to do an in-depth lesson on key levels, PDA, how to frame bias, because it's probably the most important topic and the one that, on which people struggle more. So I felt like it was a good idea. And then the other lesson that will be ready today, as well as this one, will be on time. And I want to do these two lessons together because they are, as you will see, very closely correlated. And so one complements the other, is the next step to the other. So let's start with a random chart. First of all, ICT revolutionized the trading spaces, and his way of viewing the markets, his way of seeing technical analysis is amazing. But I must say that PDAs, I use them obviously, but it's not the way, it's not the reason behind why price moves. The reason why price moves is because of liquidity, and the movement of price are dictated by time, because they are on a schedule. But the reason price move is liquidity. There are bigger entities that speculate on this market like we do, and they bring price from a liquidity pool to an opposing liquidity pool, to an opposing liquidity pool, etc, etc, etc. They do business in other ways. PDAs are just a way to view price action, to put some rules behind the price movements, and to categorize, let's say, some price behaviors. So, first of all, let's go on Nasdaq like a while ago here. Yeah. Let's do, so I will use, it's the end of 2023, and I'll use it's a random date, the replay like here, okay? And you will see why here. So let's do the beginning of June, then July, okay? And so as how can we determine bias? Well, bias, first of all, the definition of bias is price is going up, it's a bullish bias, it's going down, a bullish bias, but not price in general. I like to think of bias in relation to a specific candle. So I want to develop a monthly bias if I want to trade a monthly candle, a weekly bias if I want to trade a weekly candle. Otherwise, if the weekly is not clear, my objective is to develop a daily bias, because I trade the daily range. Generally, it's all I do. Rarely I trade 4-hour candles, and in that case, it's an intraday or session bias. So it's okay, but think always in this perspective. Give you a time frame to think. So in this case, let's do the monthly bias. And if we start down there, there are specific reasons why price is going up. So first of all, we are coming from a downtrending market. As you know, we are disrespecting bullish PDAs. We are closing to first the opening price of this order block, then the mean threshold of the order block, and in this lesson I will talk a lot because it's the best way to me to explain. note down the thing I'm saying about PDAs, because then I will make it more obvious, but this is the key to bias. Paired up with the CRT, it's the key to understanding where the market is going to, because as I said, the PDA is a tool to internalize price action. So in this case, we are disrespecting this bullish order block, and if order flow is bullish, we should see some support here. We didn't, so our mind flipped to bearish until proven otherwise. As you see, beautiful flip of the mean threshold after the block. Because why? Because this becomes a breaker once we close below here, and the mean threshold of the breaker is always respected. Why? Breaker high, low, higher high, lower low, paired up with this. And that's the reason, by the way, why this FVG isn't filled, because as you know, breaker leaves gap unfilled. So another thing to think about. And in this the market is now bearish, and we expect bullish candle to provide support and bearish candle to break bullish candle. So bullish candle, close below, this becomes support, long wick, so the wicks are gap, it's like an inversion gap, 50% of the wick is a key level, higher time frame PDA, hold high, turtle super. So we are coming off of this downtrending market, and we are now in a range market. As I said on market profile, the market moves in trend, range, trend, range, trend, range. So right now we are ranging, and what happened? Price attacked range low into, I don't know if there is a PDA on the left, but I suppose into, let's see, yeah, into an higher time frame PDA, 3 months in this case, just below the range, see? Here, beautiful respect of the FVG. And if you noticed the classic 3 candle model, candle 1, candle 2, candle 3, it's all the same, and I skip in a random point in time, so I'm making this stuff up right now. And now we probe order flow with the same logic. We're coming off with a downtrend, we smack into a higher time frame PDA, and I suppose it is in a discount of this leg. Let me see, I think yes. Premium and discount, remember, yeah. We tap in a discount of the leg, OT precisely, into an higher time frame PDA, and we are now driving up, classic range low, range high, with additional confirmation, because if market is still bearish, we should respect this monthly order block, and we close above the opening, and we still respecting the mean threshold, so it's a warning sign. That's why range low 50% and of the range and potentially reversed. And so now we want to monitor price. We close here, we close above the candle that stabbed into the low, this candle, close above. We close above also this order block, respect of the order block, and we close above this thick up close candle that caused, what is this? A breaker. So now the monthly is screaming bullish, and the target is the range high here. That's how you frame a bias, and in this case I want to frame the monthly bias, just to know. So let's remove this straight. Okay, so what's the bias for the next month? Well, after a classic, and this is a thing I want you to drill in your head this thing. After a classic buy sell candle, if and only if it reached a drawn liquidity, not the final draw, but a liquidity pool of some kind, a gap. What is this? If a classic buy sell candle, an expansion candle, reach a draw, you will expect consolidation, and it will happen all the time. So in this case, what happened? We reach this rejection block, and it is a form of liquidity pool. So now the month closes above the rejection block, and so the target is the 50% of the week, but in this case we can be safe that price will reach the range high due to this range low to range high. So the draw is this. Now we expect a consolidation candle, so a doji. If you don't know what a doji is this. Oh no. Okay. A doji is this candle. So long wick, small body. If the body was down there, in this case it is a pin bar rejection. This candle, basically. But in this case we expect a doji, a consolidation, and so we get through the month. We tapped into the breaker, the month closes, and look, we get a small body candle and a pin bar. So another confirmation that price want to go up. Now, only now, the bias for the next month is not only bullish like in this, but a classic buy candle. Because we tapped higher time frame PDA, we get expansion, consolidation, and now we expect another expansion to bring us to the final draw. There is also, there is also just above the range. This is you, okay? This is also above the range, this monthly order block, to keep in mind. And now, next candle, what do we want to do? The bias is bullish, so this is precisely what happened. A classic buy sell candle, like this one, by the way. See, small body, expansion, small body, expansion. Here, it's a consolidating, not clear direction, and so this is how you frame a bias. I will come back in this specific candle in the next lesson, so just after this one today, to spoke about your time, specific time, and how to frame the power of three of a candle. I will come, so you have a complete understanding of this. Now let's so I will leave all the drawings like this. Yeah, beautiful. Flip of the opening price, beautiful. And I don't know, we can go to euro, and yeah, I can well I can break down a trade that I actually took. So I took this live, this weekly candle. So what I saw at the time. So what I was seeing was this. Ignore this huge monthly candle, but I was looking at this intermediate term high on the monthly, and also the range high on the weekly chart. See, it's a range low, tapped, full swing, range high. So this was my drawn liquidity, and I want to reiterate, this is a trade I took. This weekly candle, what did this do? So thick weekly candle, just below there is this weekly FAG paired up with a previous volume imbalance just below. And if you want to say also the completion of this CRT, Romeo talked about this, candle low, candle high, week above, we reach candle low into another time frame PDA, but what the draw is still bullish, and the market, we are disrespecting bearish PDAs and respecting and creating new bullish PDAs. So after I get this weekly candle that rejected the weekly FVG and close above this down close candle, now to me this becomes our this becomes a order block, a weak order block, and the next candle, as you know, small body, big body expansion. I was expecting a small candle, and that's what happened. But to go more deeply, so sorry, okay, a small body candle. No, sorry, my drawn liquidity was the monthly here. The monthly rejection block is true. The monthly rejection block, and I was expecting a small body candle. What happened? Well, go to the daily. Monday opened up and attacked the range high, rejecting it. A lot of people sold up there, and I told you about this on Telegram. You said to me, why didn't you sold? And I said, I expect this not to be the high of the month. Then I was wrong on selling here, but it is what it is. I'm speaking about this trade idea. So Monday open up a large doji. Then Tuesday, I was expecting Tuesday to be the low of the week. However, Tuesday printed a inside bar. Wednesday did the same, and so in this case there are only one option. Either it is a consolidation week, or it is a consolidation reversal. So the low of the week should be formed on Tuesday, classic ICT weekly profiles. And in fact, the low of the week was formed on Tuesday. I entered here. I will break this down, same on the next lesson regarding time. I entered in the week, and Wednesday provide a small range day. Now, and Friday, sorry. Now, why did I hold? Because if a weekly candle, let's come back to the week, tapped into a small body, first of all, a small body leads to an expansion to the drawn liquidity. Then, I wasn't expecting a second touch of this key level, and this is there are advanced stuff that you will develop with the time and chart time experience. So, in this case, seeing also the lower time frames, I was expecting a consolidation, small manipulation, and go up from there. So next week, precisely what happened, and I tweeted about this, candle with the no wicks. Look, straight to the target. See? In this candle, you can't buy below the open because open and price fly, and I can't anticipate this every single time, but in this occasion I anticipate, and this is the trade breakdown of why. Now, let's go over some PDA race intricacies. So, close this. So first of all, and by the way, just a gift, this is the draw for euro. 99.9% I'm sure euro will reach up to this. Maybe now we will get a consolidation week, potentially. Maybe, I said, because we took out a major liquidity pools. But the final draw is this. So you can't consider long-term bearishness until this is taken. And the reason why is this. This is another way you frame bias, and it, in the right context, it always works. You already know how to do this, so I don't spend time. But you should blend PDA rays with a specific candle. And 3 months, I'm not using this as a random time frame. It's a quarter candle. And Romeo anticipated this rally, and I didn't. I was distracted because of this. Candle 1, candle 2, manipulation, candle 3, classic buy sell. Same on pound. Same. See? That's the reason why. So now let's speak about some PDA ray intricacies. So the PDA rays are well, fair value gap that can become an inversion gap, as you know, order block, breaker, the one I use. Also there is a mitigation block. It's a confluence to me, mitigation block. It's a confluence to me. I mainly, the most powerful PDA rays are breaker, order block, fair value gap, wicks, because wicks, long wick are gaps, and so the consequent encroachment is a sensitive point. Then rejection block, and sorry, but okay, wick is after, obviously, rejection block, and finally all the highs and lows that usually, as you know, wicks are liquidity pool, all rejection block are liquidity pool, all the highs and lows are liquidity pool, and same for fair value gap. Order block, breaker, mitigation block are specific, and also there is specific price level. Also there is mitigation block and more rare vacuum block. If you attended the core content, you know what a vacuum block is. So the key thing to understand is, as you know, that breaker, mitigation block, vacuum block, and order block are specific candles that in a bullish trend or buy program, bearish candle support price, and in a downtrend, bullish candle resist price. Now, the sensitive point of a thick order block, let's do thing well, so up close, candle, okay, so the sensitive areas of a bullish and your reverse from bearish are the opening price in a thick order block, the opening price, the 50% of the candle, of the body, because that's where the most volume resides of the body. And the rejection block only if price can wick through to the rejection block only if there is a longer wick below. But generally you should see price remaining in this a moment. You should see price remaining in this area to the from the wick to the 50%. If price close below, and this is important on a higher time frame. If price close below the opening price, it's reasonable to expect it to reach the 50%. So in a monthly, if you see a monthly order block and a monthly candle close below the opening price, go down to the 4-hour chart and trade down to the 50%. If it closes below the 50%, then trade down to the rejection block, because probably the order block won't be respected. If a price closes below the 50%, then the order block is invalidated and probably the trend is changed, shorter or long term, as I showed you before on Nasdaq. Then, intricacies of fair value gap, the same. This is a fair value gap, and the sensitive area are the high of a bullish fair value gap or a low of a bearish fair value gap. Because let's take a bearish fair value gap as an example. When price, this is high on a lower time frame, this is a lower time frame turtle soup, and that's why a sensitive area. Usually, if price wanna dig deep into the inefficiencies, the 50% is the level, and there is an example, BTC 3-month chart. 50% provide the reaction to go lower. Usually, if price close above 50% on a fair value gap, you can allow it to respect the low with the body. And so there are 3 levels on a fair value gap. Order blocks are more sensitive, usually. Now, breaker, obviously, mitigation block I already talked about. If, let's take this an example. So, oh shit, okay. Clone. Intricacies of okay, this is a bullish rejection block. Now, as I said, rejection block, you know what they are. If there are any type of long wick below, you expect a rejection block, because wicks are inefficiencies. So the key level is the rejection block itself, and if a body closes below a rejection block, it becomes another block. So body should never close below this. This should be a very sensitive level. Usually wicks can reach the 50% of the wick, and that's another key level. A wick is a gap, and so the 50% of a long wick is a key level. And another tip, that there is an example on euro. Now I will show you. Also, I will show you a vacuum block on euro that I used to trade a weekly range. Usually the candle, and CRT comes in hand, the candle before the rejection block will get taken. This lower time frame liquidity pool will get taken, and the body with a wick maybe. So this is a key level, and potentially the body will close above the rejection block, while the wick will take this lower time frame liquidity pool. So let's remove, and I will show you this on euro monthly chart. I know because I traded this. No, sorry, 3 months, where it was, well, before price closes, my target, no, maybe GU, it was GU, no, euro, before don't remember where it was. Ah, Nasdaq, okay. Yeah, recent price action. Yeah, because I traded this on a yes. Okay, not euro. Yeah, I remember. So, see, this is an example. Nasdaq, so S&P 500, yes, respected the monthly, not the opening price, but the key level to me was the mean threshold of the order block. Why? Because it was, there is always a why, because it was below this lower time frame liquidity pool. The opening price was above, so it's reasonable to see opening price and medium threshold. While Nasdaq rejected reached, because it's weaker, reached the rejection block and took the small candle, the small wick before the long wick. And this is a cheat code to turtle soup. If there is a small wick and a long wick in a rejection block, this is a sniper entry. And go back test this. If you have the wrong bias, you always touch, second touch, full swing, go up. Okay, and now I show you this is on euro, I'm sure, the vacuum block. There we go. Vacuum block, so order block with a liquidity void / volume imbalance in front. In this case, it's this volume imbalance is a new wick opening up. And I traded this to trade the weekly range. My weekly target was this same thing, rejection block on the daily, small wick. My target was this wick precisely. And so I 3 candle model, Monday, Tuesday, Monday range, Wednesday deliver precise. See the precision, see how price rejected this, then continue higher. But look, I exit here at this level with a limit order, obviously. So frame bias, market profile, and blend it with CRT and PDA to get precision. The only thing it's missing now is time. The time aspect, time the ranges, power of 3, and I will explain all I know, and well, I try, all I use, so you can become the best trader you can be. Also, forgot, this is post-production, but forgot to talk about breakers. So, you know what a breaker is, a high, a low, and once you close above the thick up close candle that closed the turtle soup, this specific candle, the closing price of a thick candle, if it's thick, if it has a long wick, you take the high, but in this case the closing price is the breaker, and you don't want to see price close below, in this case the closing price. As I said in my recent tweet, that's an indication that a breaker will deliver to the target. So breaker work, however, and that's the logic, an hourly chart is only bullish, so you have breaker as a last entry, turtle soup entry 1. So an example of a trade idea, you have turtle soup at an higher time frame PDA on the left, there is one, entry 1 turtle soup, entry 2 the thick up close candle that stabbed into the low. So we bring this forward, okay, plus an FVG. Oh shit, what is this? Every time. Okay. So entry 1, turtle soup at an higher time frame PD array. Entry 2, another block, model 1, so the block plus FVG. Entry 3, so we have also another other block here, mitigation block or breaker on the lower time frames. Look, 1 higher high, lower low, higher high, breaker, same. And the breaker on the bigger scale, thick candle that caused the turtle soup, because this is a lower time frame turtle soup, so that's why it worked. Here, straight entry number 3, straight deliver to the target. However, once we got up there, we drop. Why? Because the hourly chart was bullish until a higher time frame PD array is met. A daily order block, the candle that stabbed the eye. So the higher time frame is bullish, but this is a valid counter trend trade idea until, and this is where CRT comes in hand, until the 50% of this candle. 50% daily key level, and so the lower time frame is bullish until it's not.